Your crypto gains just got tested. Bitcoin sat near $64,000, up 1%, even after fresh strikes on Iran, and a rate hold from 3 dissenting officials at the Fed. That calm isn't luck, it's because risk assets are now trading on available cash in the market, not missiles. Thursday, July 30th, 2026. Like and subscribe for daily market updates. Today's agenda: Market Snapshot, the Fed's hawkish hold, oil and the war premium, why Bitcoin didn't blink, airline stocks and fuel costs, portfolio balance check. But what moved these prices despite the chaos? Let's look at the numbers you see right now. Bitcoin is trading at $64,568, up 1.04%. Ethereum sits at $1,914, a gain of 0.29%. Gold jumped to $4,160, climbing 1.53%. Oil retreated slightly to $83.91, down 0.6%. The S&P 500 is up 1.23% at 7,406 points. Nasdaq rallied harder, gaining 2.40% at 25,030. Solana added nearly 1%, while XRP climbed over 0.75%. Meanwhile, the dollar index dipped to 99.96. So why did Bitcoin barely move while the news was loud? 3 Federal Reserve officials pushed hard today for an immediate interest rate hike to combat stubborn inflation, but Chair Jerome Powell held firm, keeping rates steady for a 5th consecutive meeting. This decision marked a significant tonal shift, technically in favor of higher rates, because 3 policymakers broke ranks and voted against cuts or maintaining the status quo without raising interest rate signals. These dissents were the most frequent disagreements since 2016, signaling deep internal fractures on how aggressively to fight inflation versus supporting growth. While markets remain optimistic about a rate cut by September, if incoming data shows cooling faster than projected, this vote reveals the path forward is far from smooth. The mechanism is clear. When officials desire tighter policy, but refrain due to opposition or external constraints like global political instability, uncertainty spikes regarding future borrowing costs for mortgages and business loans. This hesitation creates a second-order effect, where financial institutions become more cautious in lending practices, potentially slowing capital formation even if headline numbers look stable. Historically, such discord often precedes sharper policy pivots once consensus forms, as seen after the 2016 election cycle, when debates delayed action until data became undeniable. For investors holding fixed-income assets or planning large expenditures, this unpredictable price swings implies waiting for a definitive rate cut might mean enduring prolonged uncertainty rather than immediate relief. Consequently, portfolio managers must adjust duration exposure and hedge against potential policy whiplash as the Fed navigates conflicting mandates between price stability and employment goals without clear company outlook on when monetary easing will officially begin again. Up next, why Bitcoin didn't blink. Crude prices retreated today to $83.91, down 0.6%, despite global tensions flaring overnight as the U.S. launched heavy strikes on Iran, and missiles fired back at American forces from Iranian soil just days ago have now completely collapsed peace hopes before they could take root again, unless conditions change drastically fast tomorrow morning, already waiting patiently outside right now. This unpredictable price swings underscores the fragile nature of the current war premium, a market mechanism where global political risk instantly inflates commodity prices regardless of immediate supply disruptions, only to retreat when uncertainty creates confusion among traders rather than clear panic. Historically, similar flashpoints in 2019 or during the Gulf War saw oil spikes that were equally dramatic yet often short-lived if diplomatic channels remained open. Today's scenario is distinct because the sheer scale of kinetic action has shattered any remaining trust between Washington and Tehran, forcing investors to price in a worst-case supply shock. The second-order effect here is critical. While headlines focus on immediate barrel counts, the real danger lies in potential retaliatory attacks against global shipping lanes or key infrastructure like pipelines, which would sever supply chains entirely rather than just causing temporary friction. For portfolio managers and individual investors alike, this environment demands a shift from passive holding to active hedging strategies. Relying solely on long positions is no longer viable when political noise can swing prices by hundreds of dollars in minutes. The concrete implication is clear. diversification must now include direct exposure to energy assets or protective options that account for sudden global political shocks, as the era of predictable market behavior based purely on economic underlying health has been replaced by a reality. Headlines drive price action more than inventory reports ever could again. But what happens if chip stocks stumble before the Federal Reserve meeting closes out? Bitcoin stabilized near $64,000 despite escalating global political tension and persistent Federal Reserve hawkishness, revealing a distinct decoupling from immediate global political shocks. This resilience stems not merely from investor mood, but from the asset's transition into being priced primarily on domestic available cash in the market, rather than direct reaction to foreign conflicts occurring hours ago. For investors holding digital assets across multiple jurisdictions simultaneously, this dynamic creates a unique risk profile where price action is driven by local cash availability, and big-picture economic data releases more so than missile strikes or diplomatic summits happening elsewhere right now, specifically for those managing portfolios globally, including small businesses struggling with monthly debt service payments due soon if nothing changes drastically fast tomorrow morning, already waiting patiently outside. Historically, Bitcoin often mirrored the S&P 500 during periods of extreme uncertainty, acting as a high beta proxy for risk-seeking capital flows, before establishing its own identity in late 2023 and early 2024. The mechanism behind this current stability involves institutional accumulation strategies that prioritize yield-bearing assets over speculative, unpredictable price swings when interest rates remain elevated. Second-order effects are already visible, miners reducing hash rate output to cut costs, while venture capitalists rate change toward infrastructure development rather than pure token speculation, effectively lowering the asset sensitivity to short-term global political noise. Concrete implications for investors holding digital assets everywhere simultaneously all at once together, as one big event happening across multiple countries worldwide, include a strategic shift away from viewing cryptocurrency solely as an inflation hedge against currency debasement, caused by premiums toward treating it as available cash in the market-sensitive growth instrument. Small businesses struggling with debt service payments monthly due dates approaching quickly soon if nothing changes drastically fast tomorrow morning, already waiting patiently outside right now must recognize that capital allocation decisions should focus on maintaining cash reserves rather than over-leveraging into volatile assets during Fed hold periods, ensuring they remain solvent regardless of whether Bitcoin blinks or not in the face of global instability. And finally, what does all of this mean for your portfolio balance today, specifically for investors watching markets closely right now, as we speak in this moment, exactly here and now at this precise second? Investors must vigilantly monitor airline stocks as the sector confronts an immediate available cash in the market crunch driven by volatile crude prices, failing to stabilize ahead of next month's Federal Reserve meeting. The mechanism is stark. Airlines are hypersensitive to every dollar swing in oil costs because operating margins rely on razor-thin spreads where fuel constitutes a massive overhead expense. While strong global demand often masks underlying fragility, carriers cannot simply pass soaring input costs onto passengers without risking load factor erosion or accelerating fare inflation that dampens consumer investor mood. This dynamic creates severe second-order effects for the broader economy, particularly impacting small businesses struggling with mounting debt service payments as travel budgets get squeezed by expensive logistics and fares. The current pressure mirrors historical episodes in 2008 and early 2016, when oil shocks decimated carrier balance sheets before demand recovery could offset higher costs. Today's scenario is more complex because potential Fed rate adjustments will simultaneously tighten credit conditions for these capital-intensive firms, while inflation erodes real purchasing power. If crude prices do not drop drastically fast by tomorrow morning, airlines risk a vicious cycle of reduced capacity and rising yields that threatens solvency before quarterly earnings reports can reflect operational improvements. For investors holding positions in major carriers or fuel hedging strategies, the implication is clear. Any delay in oil price stabilization could trigger sharp sell-offs as markets reprice risk premiums upward. The window to deploy capital into defensive airline plays has narrowed significantly unless global political tensions regarding energy supplies resolve quickly enough to prevent a supply shock that forces route cancellations and ground operations globally. Patience outside today does not guarantee safety. The structural link between barrel prices and ticket costs ensures that without intervention or market correction, earnings company outlook will face severe downward revisions before year-end closes. Finally, let's turn to portfolio balance check. Holding Bitcoin near $64,000 remains viable only if investors maintain gold as their primary wealth anchor, while interest rates stay above 4.65%. This yield threshold acts not merely as an economic number, but as the hard ceiling for risk assets under current global central bank policy. When yields remain elevated globally, capital naturally migrates from speculative vehicles toward fixed income instruments, offering superior real returns without significant unpredictable price swings. For small businesses struggling with monthly debt service payments, this environment creates a precarious available cash in the market squeeze. Every basis point of yield above 4% translates directly into tighter cash flow constraints as refinancing costs climb. If nothing changes drastically fast tomorrow morning, already waiting patiently outside right now, the market will likely see continued rotation out of tech and crypto toward defensive sectors. Historically, we saw similar dynamics in 2013, when high yields capped Bitcoin's ascent until available cash in the market conditions softened. Today's mechanism is identical but amplified by institutional scale. The second-order effect here is a potential compression in equity, how expensive assets look relative to earnings if the Fed fails to rate change soon enough, forcing investors to choose between capital preservation and growth exposure. Concrete implications for your portfolio balance check are clear. Do not overborrow money into volatile assets when borrowing costs remain punitive. Instead, use gold as an insurance policy against systemic shocks, while waiting for yields to normalize below 4% before re-entering high beta positions aggressively. This disciplined approach ensures you survive the next few months of potential unpredictable price swings without being forced out by margin calls or available cash in the market crunches that could wipe out gains made during previous rallies. Bitcoin held steady near $64,000, demonstrating resilience despite global political tensions and a Federal Reserve meeting that maintained higher rates with 3 descents. In the commodity sector, gold rallied on yield concerns, while oil retreated as demand weakness overshadowed geopolitical premiums ahead of next week's crucial rate decision. Airlines face continued pressure from fuel costs if crude remains above $83 per barrel tomorrow morning. These divergent signals highlight a complex landscape for investors closely monitoring precious metals and energy sectors right now before the session concludes properly later this week. Thanks for watching Market Pulse Daily.